Dominic Johnson of Somerset Capital Markets now joins in on the show. Dominic, thanks very much for being with us. If you could just tell us how you think the emerging market landscape is looking as things stand today. Will you be allocating more money to these geographies, and which markets do you think look most attractive?
I mean, the emerging market landscape at the moment is really fascinating. If I go back a year, so first quarter of 2011, and told you that the emerging markets were going to be down 20% and the US was going to be up 5%, you thought I was completely bonkers. What actually happened was last year was a terrible year for emerging markets. As we came into December, Somerset Capital Management, the business that I'm involved with, which specialises in emerging markets, really felt a lot more confident about the particular countries going forward, particularly since the markets had sold off so heavily. So we started to look around for companies that were very bombed out, that were representing very good value, that maybe had very good yields. So being a lot more inquiring, having been quite negative on emerging markets over the last sort of 12 to 18 months. So where are we now? We're in a situation where valuations count. And I've been investing in emerging markets probably for about 17, 18 years. And always, if you get the valuation cycle right, then you reduce your risk. And a large part of the sort of effort of trying to work out timing, a lot of that work is done for you. So in comparison, emerging markets are on about 11 times. Historically, they traded an average of about 14 times. So just on that broad front, we are relatively optimistic about the markets as they stand. However, and this is really important, jump tracks and look back at some of the country's specific issues. India has had its own internal problems and has disappointed us as far as regulation is concerned and governance. China has had also its own issues, and I think there are some rumblings under the surface there, not just political but economic too. Brazil seems to have been a bit lax about its economic policy and thinks that constant interest rate cutting will help it get growth again. And some of the other economies like Turkey and Russia haven't performed as we would have liked. So on the broad surface, valuations are attractive in emerging markets, and so we feel quite optimistic. But if you go down to the micro level, the country level, and then the stock specific level, you have to be very, very selective and ensure the businesses you're buying have got good valuations themselves, but also have the sustainability. They can generate their own cash, they've got the quality of management and the markets in which to flourish. And that's a much more challenging job.
Right now, Dominic, inflation has resurfaced as a key risk to Asian emerging markets. Would that lower your weightage on Asia?
Inflation's always an issue. You very kindly invite me to come and comment on these programs from time to time. And the core thread that links many of our concerns together is inflation, particularly when you look at fuel inflation and commodity inflation. And the run over the last 10 years for emerging markets, and China particularly, has been fueled by effectively low commodities, if you go back to the early 2000s. And that enabled incredible expansion of building and fixed investment and capital investment, transportation systems and building and materials and so on. So you have to now be in a position where these things are fundamentally more expensive. And not only that, but wages have increased substantially as well. Countries like China that were highly competitive are now not so competitive, particularly if you compare them to the more frontier markets like Bangladesh. So inflation is an issue. Personally, I think that China has done a lot of quite good work in curbing its inflation. I think other countries like Brazil haven't been so forward-footed. India probably sits in the middle. You have to watch on a short-term basis for oil prices. That can really squeeze countries that obviously import a lot and have subsidies on their oil. So overall, I think a lot of the nasty inflation froth has been taken out of the emerging markets, but I certainly wouldn't think that you can relax on this front. And if anything is likely to destabilise our more optimistic view on emerging markets, it's probably going to be something linked to inflation as far as sort of fundamental economic issues are concerned.
Dominic, the spreads between the onshore and offshore corporate bonds of Indian companies are also wide, but not that wide as of China, despite all the regulatory bungling on the part of the Indian government. Do you think this could be reflective of the foreign investors having greater faith in India over China?
Yeah, I'm interested. You mentioned the word regulatory bungling. For me, India is one of the greatest investment opportunities there is in emerging markets, or in fact globally at this time. It has an incredibly dynamic population. The demographics are enormously powerful. I think 1 in 10 individuals globally is an Indian under the age of 25. The education levels in the middle classes are extremely high. They're consumers. They like to spend. The issues, of course, then follow through that why aren't they doing more about it to make their economy more dynamic? And politics is the real problem. When people compare India and China, often you see that the tortoise and the hare. China, because of its political system, is able to charge ahead and do what it likes as far as infrastructure spending is concerned, investment is concerned. You know, they want to build a new airport in China, and I think they're building something like one a week. It takes them a few months just to get the approval signed. In the UK, it takes about 20 years just to get an extra runway, and India's just as bad. So it's frustrating, the Indian market. I don't think you can necessarily blame the widened spreads or the slight trend in widening spreads on any specific regulatory issue. But there is a sense of frustration with the international investor looking at India. They're making it more and more difficult for us to invest. The Vodafone issue is a very good example. There was a lot of concern over the use of P-notes, which is a way to get into India if you're an international investor. Again, trying to make things more complicated and more uncertain. And if you do that, then what happens is investors tend to shy away. So all the fundamentals in India look really promising. But in the short and medium term, I really want the Indian government to get a grip of the situation and start showing the international investor that they are welcome and that they'll have stability for their investment horizon.
Now, Dominic, the interest rate cycle in Asia is seen turning in coming months despite the challenge of inflation as central banks in the region push for growth. Now, could the turn in the rate cycle act as a trigger for greater capital flows to Asia, or would you say foreign investors will be looking for far stronger positive signals than just that?
Well, as I said at the beginning, the core investment case for emerging markets in Asia is, I think, quite sound at the moment. On pure valuation basis, there are a lot of great companies growing at a good rate that are properly valued, and as an investor, that's what you want to look at. If you focus on the macro issue of the sort of declining interest rate environment, you have to slightly ask yourself why. I think nowadays we're fed a diet that low interest rates equals good, high interest rates equals bad, but actually that they're a reason, that they're a response to economic activity. So if you have very low interest rates, or indeed you're looking to cut interest rates, it's probably because you're a bit concerned that the economy is a bit sluggish. So be aware of that when everyone rejoices at another interest rate cut. We have practically zero interest rates in the United Kingdom, and that's because our economy isn't growing and we have serious economic problems. So it's not a good direction of travel necessarily. You want a balanced interest rate that encourages saving and allows investment at a reasonable cost. So ultimately, monetary policy is powerful in giving a bit of liquidity boost, but that's not going to be the reason in my mind why people continue to invest in Asia and will look to see their allocation cycles increase. And just to finish on one point, in my business, Somerset Capital, we are dealing with international investors who are looking to access these emerging markets and Asian markets, and I'm seeing a very strong trend in a continuing increase in the percentage of money they place in emerging markets versus the developed markets and Europe. So that in itself is a positive sign, but it's not going to be linked simply to interest rates being cut. If anything, you have to be a bit cautious about hoping for substantial slices in interest rates, because it may mean the economies aren't as strong as we hope.
Dominic Johnson, pleasure having you with us on the show. Thanks very much for joining in and giving us that view on the emerging markets and what you make of them.